Greetings, my name is Ted Hicks. I'm the founder, CEO, and Chief Investment Officer for Hicks Associates Wealth Management. Today's Friday, July 28th, 2023, and in today's video, I'm going to provide an update on the TD Ameritrade to Charles Schwab conversion. I'm also going to talk briefly about the economic data that we just got yesterday. But before I do, I would be remiss if I didn't introduce my firm to those of you who are new to our channel. Hicks Associates Wealth Management serves individuals and families in a proactive capacity. We serve our clients by being intimately familiar with their finances so that we can guide them proactively in making financial decisions. For most of our clients, we also serve as portfolio managers, managing their investments in a truly active fiduciary and fee-based approach. If you want to learn more about me and my team, just simply go over to hicks-associates.com. Once there, you're welcome to drop us a line if you'd like to learn more or schedule a time to meet with me or one of our lead advisors. That said, let's dive in by looking at the GDP information that was printed yesterday. On the screen now is the GDP chart that we were looking at in last week's video. You'll recall in last week's video that we were discussing whether or not we are going to see a quote-unquote soft landing. Remember, the Federal Reserve is trying to get rid of the high inflation. We've seen inflation at 40-year highs. Federal Reserve is rightly taking action, but what they are trying to do is slow the economy down, get rid of the inflation, but they do not want to cause a recession. So what we were looking at last week is if you look on the right side of the screen, these red bars, that's what we would like to see in the GDP numbers so that we can see, yes, the economy is contracting, but we don't actually see a recession. Remember, a recession is when those histogram figures go negative. Well, this week, just yesterday, as a matter of fact, we got the second quarter GDP for this year. It actually came in at 2.4%. So that is actually higher than the first quarter. And there's a lot there, and I won't go into a ton of detail other than to say that we still don't see a recession. If you've been watching our channel for any length of time, you know that there has been the highest number of economists ever have been declaring that we're going to see a recession this year. We've been hearing it for more than a year. Recession is coming, recession is coming, recession is coming. And we have frequently stated that the masses are very rarely right, especially when it comes to economics. And so we've been skeptics for a lot of reasons, but we've been skeptics from the very beginning that we don't think we're going to actually see a recession this year. So far, the data supports that conclusion. However, let's look at the yield curve, because again, if you've been watching our channel for any length of time, you also know that a yield curve inversion is one of the best, and some would argue the best, economic indicator to determine if we're going to see a recession. As a recap, an inversion is where this figure goes negative. So that black line on the chart is the zero line. And so when we go below that line, that's an inversion. And you get this figure by taking the yield on one bond and subtracting the yield from another bond. And there's lots of different variations of these yield curves, but we tend to look at the 10-year yield minus the 3-month yield because the leading economic researcher on this topic would say that's the best version of the yield curve to predict whether or not we're going to see a recession. So the yield curve, this one in particular, as well as many other versions, but this one is the one we like. This yield curve has been inverted since October. Is it predicting a recession? Yes, it is. That doesn't mean it's going to happen. Now, many would say, rightfully, that so far this yield curve has a perfect record in declaring or predicting a recession. And we would say that's true. However, number one, that doesn't mean it's always going to be true. There are plenty of economic indicators that have a high probability of predicting something, but it's not 100%. So far, this yield curve has a 100% accuracy rate, but that doesn't mean it's going to stay that way. That's the first thing. The second thing to know is this yield curve inversion may very well be predicting a recession, but it cannot be used as a timing device. Let me show you what I mean. So on the screen now is the same yield curve that we were just looking at, the 10-year yield minus the 3-month yield. The difference is I'm going to go back in history here. So on the far left of the screen is 1982, but in particular I'll guide your eye right over here. This is approximately May 1989 when this yield curve went negative. So that's when this yield curve inverted, and I want you to see that it took 14 months before that recession actually started. So let's fast forward. Here's another one. Now this inversion is in September of 1998 when it first went negative, but you can see that it went negative and it bounced back to the positive. Well, from when it first went negative to the beginning of that recession, it actually took 30 months. That's 2.5 years. Now you might say, well, this one doesn't count because it went negative for only a couple of days. Fine. So then we look again, it went negative again in July of 2000. It took 8 months before a recession actually started. Keep that in mind. Here's the best example on this particular yield curve. We see that the yield curve went negative in, January of 2006, but a recession didn't actually start until January of 2008. That's 23 months. Then we have the brief inversion in 2019. Took 9 months for a recession to start. Where are we at now? Well, again, this yield curve first inverted in October of last year. We're only 9 months into this. So again, there is history of this yield curve inversion taking, 30 months before a recession actually started. So this yield curve might very well still be predicting a recession, but the recession is still in the future. As for us, we still don't think it's happening this year. We could be wrong, but that's what we're seeing. Now, let's switch gears and talk a little bit about the TD Ameritrade to Charles Schwab conversion. The merger between TD Ameritrade and Charles Schwab has been happening behind the scenes for several years now, but as the date of conversion is rapidly approaching, we want to provide a quick update. So for every account that you have at TD Ameritrade, you will get a new account number at Charles Schwab. You should be receiving in the next few days a packet in the mail that contains your new account numbers. Now, if you would like, as soon as you get that packet, you can go ahead and set up your online access to Charles Schwab's website. Now, just keep in mind that when you do get logged into Charles Schwab, you will very likely see zero balances. Don't be alarmed. That's to be expected. You will still have access to view your accounts over at the TD site up until that conversion date, which is going to be over Labor Day. So we would encourage you to go ahead and get your online access set up, but don't be alarmed if you see zero balances. Now, that said, if you are a client of ours, we continue to encourage you to use our client portal. You can find our app in your favorite app store, whether it's the Google Play Store or the Apple iTunes Store. You will find our app. And if you need access, just contact us and we will help you get logged into the client app. That information will not change with this conversion. This is one of the many reasons why we are encouraging you to use our client portal and our app on your smart devices. Now, that said, this conversion is going to happen over the Labor Day weekend. So it's going to start officially happening on September 1st, and then it should be completed on Tuesday, September 5th. So especially during that Labor Day weekend, again, don't be alarmed if you log on and you see zero balances. Don't be alarmed. That's to be expected. This conversion is that's why they picked that longer weekend for them to do this. Now, if you have standing instructions for money movement, in other words, if you are sending us money every month, or you're sending money to your TD Ameritrade account, or if you are receiving money from your TD Ameritrade account, you do not need to take any action, especially if you are a client of ours. One of our first things that we're going to be doing on Tuesday morning after Labor Day is logging in to verify that everybody that's got money movements, standing instructions, that is still set up and proceeding as normal. Naturally, if you have any questions on any of the information on the screen or anything else about this conversion, by all means, feel free to reach out to us directly. So that said, we thank you for watching. We certainly hope these videos are helpful. If you have any questions, again, feel free to reach out to me or our team. You can find our information at hicks-associates.com. Again, thanks for watching, and we'll see you next week.